So you've got $1,000 to invest and you want to start doing something. Where do you begin? Today we'll walk through exactly what a complete beginner can do with $1,000 to kickstart a long-term investment journey. Don't worry, we'll keep it simple, optimistic, and beginner-friendly.
Let's go! Too easy, dude! Give me that crown!
In this video, we'll cover why investing beats just saving money, show you how to invest wisely through diversified ETFs instead of taking risky stock picks, introduce you to 3 high-quality ETFs to consider, and a little projection of how much your $1,000 can grow in 5, 10, 20, even 30 years. Hopefully at the end, you will feel inspired to get started on your own investing journey. First, let's talk about something that often silently steals value from your money: inflation. If you leave $1,000 just sitting in a checkings account or a basic savings account, it won't be worth $1,000 for long in terms of what it can buy. And why is that? It's because prices of goods and services tend to rise over time, and that's called inflation. Think of it this way: keeping cash under the mattress or even in a low-interest bank account is like watching ice melt. The longer you wait, the less ice, money power, you have. Inflation in the US has historically averaged around 2 to 3% most years. It doesn't sound like much, but over time it adds up. At 3% inflation, your money loses about 25% of its value in just 10 years and roughly half in 24 years. And in high inflation periods, it's even worse. So what's the good news? The good news is that there's a way to fight back against inflation eroding your hard-earned cash, which is investing. By investing wisely, your money can grow at a rate that outpaces inflation, meaning you're not just preserving purchasing power, but you're also increasing it. So imagine leaving that $1,000 in a savings account. Many savings accounts in 2025 still offer low interest. Some higher yield accounts might even give you a few percent, but often after inflation, you're barely breaking even. In contrast, the stock market, which you can easily invest in through funds, has historically offered around 10% average returns, and that is before inflation. So for example, the S&P 500 index of the big US companies has delivered about 10% per year on average since 1957. And that's the power of the market. Over the long run, it tends to grow, turning small contributions into much larger amounts. By investing instead of just saving, you're putting your money to work for you. Each dollar has the chance to earn more dollars, that's interest or investment return, and then those new dollars can earn even more. It's the magic of compounding growth. But first, we need to understand how to invest wisely as a beginner. There's 2 words right here. It's called diversified ETFs. And you see, when you're just starting out, you might wonder, should I pick some hot stocks with my $1,000? You certainly could go that route, but picking individual stocks can be risky and requires a lot of research. Even the pros often fail to beat the market. Over a 10+ year span, 85 to 90% of professional fund managers underperform the simple S&P 500 index. Stock picking looks easy during bull markets, but the numbers prove that it really isn't. For a beginner, a smarter approach is to buy broad market ETFs, which are also known as exchange-traded funds that bundle many stocks together, giving you instant diversification. Think of an ETF as a basket of stocks. Instead of just betting all of your money on 1 or 2 companies, which could stumble, you could own a slice of hundreds or even thousands of companies at once. This diversification spreads out your risk. If one company in the fund has a bad year, it's balanced by others who are doing well. You don't have to guess the next Amazon or Apple. By owning an ETF that tracks the whole market, you own a little bit of everything. And as the overall economy grows over time, so does your investment. ETFs are also easy and low cost. They trade like stocks. You can buy them at any brokerage account, but they usually have very low fees and require little to no active management from you. It's a set it and forget it approach. perfect for beginners, and actually even many experts recommend them for most retail investors. Now let's introduce 3 specific ETFs that a beginner could consider in 2025 with that $1,000 initial investment. These are all well-established, low-cost, and diversified funds with strong track records. Here's the breakdown. First, SCHD, the Schwab US Dividend Equity ETF. SCHD focuses on high-quality dividend-paying US stocks. Essentially, it holds the 100 of the strongest dividend companies in the whole US. Think of well-established, profitable firms that return cash to shareholders. Why is it great for beginners? It gives you a diversified basket of solid companies with the bonus of dividends. Dividends are cash payments companies make to shareholders, and SCHD's holdings are known for reliable payouts. The next one is VTI, Vanguard Total Stock Market ETF. So what is VTI? VTI lets you own the entire US stock market in one fund. It holds over 4,000 stocks, basically every publicly traded company in the US, from the largest giants to the small startups. If it's a US stock, it's probably in VTI. So why is it great? Let's talk about diversification. VTI is as diversified as it gets. You got big tech, mid-sized companies, small caps, you get all of them. This means you're capturing the total market's return. It's a one-stop shop for US equity investing. It's perfect for a beginner who wants a broad exposure as well. The next one is VOO, Vanguard's S&P 500 ETF. So VOO tracks the S&P 500 index, which is the 500 largest publicly traded companies in the US. Actually, just around 500, sometimes there's a few more. These are big players here. Think of Apple, Microsoft, Amazon, Google, Tesla, JP Morgan, etc. If VTI is the whole market, VOO is the core of the market, mostly large cap, industry-leading companies. Why is it great? The S&P 500 is often considered the benchmark for the US stock market. It captures about 80% of the US stock market's total value in those top 500 companies. By investing in VOO, you get instant exposure to the biggest, most successful firms in America, spread across all industries: tech, healthcare, finance, consumer goods, etc. All 3 companies have strong track records and low fees, making them ideal for long-term investing. You really can't go wrong starting with a combination of these as a beginner. All right, now for the really fun part, which is the projections. Let's see how that $1,000 can potentially grow over time in an invested, diversified stock market fund like the ones we've discussed in this video. We'll assume a compound annual growth rate at about 10%. We'll also assume you reinvest any of the dividends and stay invested through the years. With no panic selling, you're in it for the long haul. So first, let's consider scenario A. You invest $1,000 once and you don't add a single dollar after. You just let it sit in, say VOO or VTI, for years to grow. How much could one-time $1,000 become? At 5 years, at 10% per year, your $1,000 could grow to roughly $1,610. Really not huge, but already 61% higher than your starting initial investment and already beating inflation. After 10 years, it's about $2,600, more than doubling your money. After 20 years, it would be about $6,700. After 30 years, it will be roughly $17,500. Now let's look at an even more exciting scenario, which is scenario B. You invest that $1,000 and you add $100 every month thereafter. This is a realistic scenario for someone who starts with a lump sum and continues to save, invest regularly, which is often called a dollar cost averaging technique. After 5 years of just putting $100 a month contributions, that's $6,000 of your money contributed over 5 years, plus that initial $1,000 start. You could have around $9,300. After 10 years, your account might be roughly $23,000. After 20 years, it's potentially about $83,000. And after 30 years, it's roughly $245,000. Again, you've contributed $1,000 plus $36,000 over 30 years. And with the power of compounding and consistent investing, it turned into nearly $250,000. That's the astonishing impact of adding regular contributions. Think of the difference between scenario A and scenario B like a snowball rolling down a hill. Scenario A, that one-time $1,000 payment, is like a snowball that you push once, you'll gather some snow and grow. But scenario B, when you're also giving that $100 monthly, is like you're continuously adding more snow to that snowball as it rolls. By the time it's at the bottom of the hill, decades later, of course, it's massive. This is how ordinary people build wealth. They start early and consistently, and letting time do the heavy lifting thing, become a big snowball. Now, of course, these are projections, assuming around 10% average returns every year. Now, actual market returns will vary year to year. Some years it will be plus 20%, some may be minus 10%. But historically, over long periods, around 10% has been a reasonable figure for US stocks. Even if the future average is a bit less, let's say 7 to 8%, the strategy of investing early and often still yields impressive results. The key here really is to go long-term, patient investing. This is not a get-rich-quick scheme. It's get rich slowly but surely. So what can a beginner do with $1,000 in 2025? Well, try to invest. Put that money to work in a diversified ETF like SCHD, VTI, or VOO, or a mix of all of them. By doing so, you're shielding yourself from inflation, which otherwise will nibble away all of your cash, and harnessing the growth of the stock market. History shows that time in the market beats time in the market. The sooner you start, the more the compounding snowball can grow. Think of your $1,000 today as a seed. With patience and care, that seed can grow into a tree that bears fruits, dividends, and stands tall, market value, over the decades. In 30 years, you'll be glad you planted that seed in 2025. It's an optimistic vision and is entirely achievable by starting now and sticking to the plan. And until next time, stay patient, stay invested, stay smart.